In this video, I'm going to show you exactly how to start day trading as a beginner in 2026. This isn't theory and this isn't hype. In fact, one of my students, Wolf, recently acquired $1.5 million in prop firm funding using the exact model I'm about to teach you. You've probably seen traders online passing evaluations, pulling big payouts, and making consistent money with trading. That's not because they found some cheat code in the market. It's because they follow one simple model that fits their personality and they never break the rules that come with it. And here's the part most beginners get wrong. They don't lose because trading is impossible. They lose because they learn the right things in the wrong order. So in this video, I'm going to break down exactly how I would start day trading in 2026 as if I was a complete beginner, what to focus on first, what to ignore, and how to avoid the mistakes that wipe out most new traders early. Because I genuinely believe that if you take all of the free content on this channel, apply it correctly, and stay consistent, you can become a profitable trader. And in the next 10 to 15 minutes, I'm going to take you through the exact beginner roadmap you can follow so that you're starting the right way from day one. Most beginners come into trading focused on how much money they want to make. And that's exactly why they struggle. Because trading isn't a results game first, it's a process game. The truth is, focusing on money too early in the game is the fastest way to sabotage your trading. So before we talk about entries, risk, or models, we need to reframe how you think about trading entirely. Because this is the difference between traders who last and traders who burn out. If you judge your trading by your profit and loss, every trade is going to feel emotional, even the good ones. Here's the problem with outcome-based thinking. You can do everything right in a trade and still lose money. Conversely, you can do everything wrong in a trade and still make money. So when you focus on the outcome, you end up rewarding bad behavior and punishing good behavior without even realizing it. Process-based thinking flips that completely. Instead of asking, did I make money, you start asking, did I follow my rules? Because consistency doesn't come from winning trades, it comes from repeating good decisions. So if money isn't how you should be judging your trading, then what is? That's where something I called the trader scorecard comes in. Instead of tracking profits first, you're tracking execution. After every trade, you ask yourself 3 questions. Did I follow my setup's rules? Did I manage risk correctly? Did I exit according to my plan? If you went 3 for 3, that's a successful trade, regardless of the outcome. This is how traders detach emotionally while still improving. Money becomes the byproduct and not the goal. And this is the part most traders don't understand yet. The market doesn't reward you for wanting money. It rewards you for consistency. When you execute the same process over and over, your data improves, your confidence stabilizes, your mistakes become obvious, and your edge actually shows itself. That's why traders who survive long enough eventually become profitable. Not because they got smarter, but because they stopped letting outcomes control their decisions. Once you stop obsessing over outcomes and focus on the process, trading becomes a lot calmer. But here's where most traders still mess up even with the right mindset. They have no clear roadmap on what to learn next. So they bounce from strategy to strategy, waste months and sometimes years without ever building real consistency. Most beginners don't realize they're sabotaging themselves while thinking that they're learning. Here's what usually happens. You learn one strategy, you take a few losses, then you see another trader doing something different. So you switch, then you switch again, and again. That feels productive, but it's actually the fastest way to stay stuck. Because every time you jump strategies, you reset your progress back to zero. When it works, when it doesn't, and why. This is how traders spend years studying the markets without ever becoming actually consistent. So if strategy hopping doesn't work, then what does? Consistent traders don't learn everything at once. They follow a roadmap. A roadmap tells you what to learn first, what to ignore for now, and what comes next. Without that order, even good information becomes dangerous. You start applying advanced concepts onto weak fundamentals, and that's when confusion, hesitation, and overtrading creeps in. A roadmap removes decision fatigue. You stop asking which strategy should I try next, and instead you ask, did I execute my current step correctly? This is the part most traders don't want to hear. There are no shortcuts in trading. You can skip fundamentals, but the market will charge you for it later. When fundamentals are missing, losses feel random, confidence disappears, and emotions take over execution. But when fundamentals are solid, trades make sense, mistakes are obvious, and improvement becomes measurable. Every consistently profitable trader went through that same phase, mastering the basics before trying to be advanced. The difference is they didn't rush it. So now you understand why mindset alone isn't enough, and why random strategies keep traders stuck. The next step is learning to build on a foundation instead of guessing. And that starts with understanding how the market actually moves. Most beginners think candles are signals, but they're not. A candlestick is just a snapshot of price over the course of time. Green and red don't mean buy and sell, they simply show who had control during that period. Once you understand that, candles stop being patterns and start being information. So, how can we actually read one of these candlesticks? If you notice, there are 4 main levels on each candlestick that we actually care about. The first level is going to be your open. This is where price started trading at the beginning of this candle. So if this is a candle on our 1 hour time frame, we know that this open had to be at the beginning of a new hour, such as 9 a.m. So if we know that the open is at 9 a.m. and this is a 1 hour candle, then our close, which is up here, will be at 10 a.m. because this whole candle lasted for an hour of time. So now that we have our open and our close, what are these 2 lines right here? Well, these are what are called wicks. So you have your body and you have your wick. The wicks of the candles are not things that occurred outside of that hourly time. They're simply where price reached but rejected before closing that candle. So if this is the opening of our high time frame candle, our hourly candle, and this is the makeup of the low time frame, like such as the 1 through 5 minute, we can see that as price is forming, we currently have an open, which is this level here, and a close, which is this level here. But this candle is still forming. So this isn't the final form of this candle. When price trades down to form your manipulation, this candle becomes red because we have now flipped under our opening price, and this candle is now bearish because it's below that level. If you'll also notice, what was a green body is now just a wick because this candle has gone from bullish to bearish, and price is no longer up here. Now that we've manipulated, we can take price higher, such as this, which now makes our candle look like this. We have our opening price, which is right here. We have this wick that was caused by where price went, but no longer is. And the reason that this is a body and not a wick is because the price is still open, right? So the open is here, we traded higher, and we have not traded any higher than where we are right now. So that's why we have a wick on the bottom from here, and the body that was formed from this big move. On our final retracement here, when we come back down into the range, this is now going to be my wick because price closed back under the high that we formed. So we opened, price traded lower, formed this wick, traded higher, higher again, formed this wick, traded lower, and closed. This is how each and every candle moves no matter which time frame you're on. This can be your hourly time frame, your 30-minute time frame, your 5-minute time frame, your 1-minute time frame, your seconds time frame. This is how each individual candle is built. Now that you understand candles, the next question is, where do they matter? Price doesn't react everywhere, it reacts at levels. Here I've drawn out a basic chart. No information, no nothing. This is just what a normal chart looks like. Inside this chart, you have these areas that price likes to bounce off of repeatedly. You can see it here, here, here. We have some here. We have one here, right? These levels are called support and resistance. You'll hear this talked about in a lot of different ways. It'll be called support and resistance. CRT is one, liquidity, fair value. All of these are just unique ways to talk about a specific level on your chart. These levels where we expect price to react from and build off of. My model is relatively simple. We focus on these levels here inside these support and resistance levels, and we use that to capitalize on the market. Your job is to observe how price behaves at these levels. You don't just enter and exit based off of these alone. There is more strategy to it. However, this is the basic understanding of how a market moves. You can see exactly what I'm talking about on this 15-minute chart. Price just bouncing between these levels that were formed. Up to this point, we haven't talked about strategies, entries, or setups. And that's on purpose. Right now, this is simply about understanding how the market moves, how price behaves, and how to read what's happening in real time. Because once you can see the market clearly, the next step is learning how to apply a strategy to it without guessing or forcing trades. At this point, a lot of people think the missing piece is intuition. They think profitable traders just feel the market better. But that belief is exactly what keeps people stuck. Emotional, inconsistent, and second-guessing every decision. Gut feeling trading sounds advanced, but it's actually one of the biggest beginner traps. If your decisions were based on how you feel, then your entries would move, your stops would move, and your exits would move. And even if you did win, you wouldn't know why it worked. And that's how traders stay stuck for years, winning randomly and losing confidently. A mechanical strategy removes the guesswork completely. It's a rule-based approach where the setup is there or it isn't. There's no gray areas, there's no almost, there's no convincing yourself. You're not asking, do I feel good about this trade? You're asking, does this trade meet my entry criteria? That's it. Most traders think more strategies means more opportunity. In reality, more strategies just means more confusion. Every strategy has different rules, different risk, and different expectations. So when you jump between methods, you never build real data. Using one mechanical strategy allows you to track performance, spot mistakes, and improve deliberately. Having the least amount of variables in trading is the best way to do it. They protect you. They remove hesitation, overconfidence, and emotional decision making. They let you show up every day knowing exactly what your job is. And that's when trading becomes calm, boring, and consistent. So now you understand why intuition keeps traders emotional and why rules create consistency. The next step is seeing how all of this fits into one repeatable process. Because a strategy only works if you know how to execute it the same way every time. This is where everything we've talked about collapses into one repeatable process. The model I use and teach is called the Trinity model. It's mechanical, rule-based, and designed to remove guessing completely. There are only 3 steps, and they must happen in order. Every trade starts with a bias. Bias answers one simple question. Am I looking for buys or am I looking for sells? Without bias, everything looks like an opportunity. And that's how beginners overtrade. Bias forces patience. If the bias isn't clear, then the trade doesn't exist. That's not discipline, that's just the rule. The way I get my bias is very, very, very simple. I use an indicator called the OHLC stat map by Joshu. This indicator uses every single daily candle that I have available on my TradingView plan, which for me takes me all the way back to July of 1999. And it uses each and every one of those candles to automatically plot the next candle. For us, that's a daily bias, right? So getting the next daily candle would help us find that bias. To do this, it opens a new projection at midnight open. So if I'm on my hourly chart here, each of these are going to be an hourly candle, and it plots what are called manipulation levels. Now, manipulation levels are a lot simpler than they sound. It is literally just that support and resistance that we were talking about earlier. So if we come down into one of these areas and it respects it, we can expect it to push price higher. If you look at this example here, we come down to this level here. And so I'm going to have a bullish bias because we respected this bullish manipulation level. And if I play this out, you can see that that's exactly the bias we needed to have for this day. So coming into the day, I look at my stat map. If we have tagged bullish manipulation, I'm bullish. And we have tagged bearish manipulation, I'm bearish. And if we haven't tagged either, there's no trade to take. So on this day, we tagged bullish manipulation. So now we can get into step 1, which is going to be finding that support and resistance on our high time frame, right? That area in which we want to find the trade. To find that area of support, I'm going to look for a very specific candlestick pattern. We're going to look for 3 candles in which the first candle's wick does not overlap the third candle's wick. This creates a space in between those 2 wicks in which the body of candle 2 is creating what's called a gap. More specifically, it's called a fair value gap. So I'm going to look for a bullish fair value gap on my 15-minute chart or higher to find that support zone. As you can see on our 30-minute chart here, we have that exact pattern. We have 1, 2, 3 candles in which we have a space between the first candle and third candle's wick. So this area right here is where I'm going to look to spot my trade. Now we can get into step 2. Here I've drawn a normal chart. For me, I'm going to draw this as the NASDAQ or NQ. Now what I've done is duplicated this chart and wrote the letters ES. The reason that I did that is because this chart represents the S&P 500. Now why do they look the same? It's because NQ and ES are what are considered correlated pairs, which means that they move in tandem with each other. So if the NASDAQ moves up, then the S&P 500 is going to move up. If the NASDAQ moves down, the S&P will also move down. Step 2 comes into play when we get a crack in that correlation. Or in other words, when one of these pairs makes a higher high and a lower high, and the other one stays at a lower high and a higher high. This simple crack and correlation right here tells me that the market is about to make a large move. I know this because I can see it historically. If we look at our daily time frame, or even our weekly time frame, and we look at these big reversal points here, you'll notice that at this high right here before this run down through all of 2023, NQ made a higher high and a lower high, and ES in the same spot made a lower high and a higher high just before that big move down. Now, this isn't the only example. If I go back in time as well, you can see here that just before this massive launch in 2020, we got that crack and correlation again between this time, this low, and this low. And if you look at ES, in the same exact spot, we have a higher low and a lower low. That crack and correlation before we make a big move. So to apply this on my smaller time frame is very easy. We're going to start looking for this crack and correlation when we tag into that gap that we drew from earlier. Here's 9:30 at market open. So after market opens, we'll wait for a tag into that gap, which we get right here. As you can see, we wick that gap. And so now I'm going to start looking at this low right here for any change in correlation between this and the S&P 500. And if I pull up the S&P 500, you can see that we have a lower low and a higher low here. And in the exact same spot, NASDAQ is forming a higher low and a lower low as we're tagging into this gap. So now that we have these two things, we have both our high time frame gap and we have our crack and correlation, we can now look for our final step, step 3. If you'll remember earlier, I showed you how a normal fair value gap forms. But what happens if one of these gaps gets completely disrespected? Well, if you have a normal bullish fair value gap that gets closed below, it becomes what's called an inversion gap. And instead of expecting price to push higher, we're now going to expect price to push lower. This can be used to our advantage because we're seeing how price is shifting from a buy side into a sell side. And seeing this happen on a small time frame when we've already tagged into our high time frame gap tells us that's exactly where the market needs to go. If you'll look right here, you'll notice that after we tag into this gap that we drew from step 1, and after we got this divergence from step 2, we formed a bearish fair value gap. The reason we're looking for a bearish fair value gap to get inversed is because that's what will push price higher. If we wanted to go short, we would be looking for a bullish gap to get inversed. But since we want to go long here, we're looking for a bearish gap to get inversed. And all we need for that is a close above this level here. And as you can see, on our very next candle, we get a close above this gap. And that is all that's required for me to actually enter this trade. So I'm going to set my entry right here. No limits or anything. As soon as this candle closes above this level, I market order a buy. And I place my stop below this level right here where we got that divergence from earlier. And my target is super simple. It's literally just a 2R. You don't need anything more than a 2R. A 2R meaning that you are risking essentially 100 to make 200. So if I enter this trade, let's play this out. As you can see, we came back into our drawdown by just like a little bit, but it went straight to this level up here that we were looking for. And this is exactly how I enter my trades. I wait for these 3 things every single day. Once I have my bias, I look for the high time frame gap on my 15-minute chart or higher. I wait for a tag into that gap on my low time frame, and I wait for divergence to provide me that this is the gap that we actually want to trade out of. And then I get the actual entry, which is the inversion gap. I want to really quickly show you a bearish trade as well. So to recap the steps for the model, after you get your bias, step 1 is going to be a high time frame fair value gap. Step 2 will be divergence between NQ and ES. And step 3 will be that inversion gap on my 1 through 5 minute chart. And that is the Trinity model in of its whole. Very simple, consistent, and repeatable. And once you have it down, it's really hard to miss. Let's now take a look at a bearish example. Here, as you can see, we have not tagged either manipulation level. But if I trade it through, you'll notice that we do end up tagging our bearish manipulation level. Now this happens right around our 8 o'clock candle. So now that we've tagged bearish manipulation, I know that I'm going to be bearish for this day, which means that I can start to look for my high time frame fair value gap. So I'm on my 15-minute time frame here, and as you can see, the closest thing we have that's next to our manipulation level is going to be this 15-minute bearish fair value gap right here. So if I draw this out and mark it gray, you'll notice this is the bearish gap I'm going to use. So I can wait for price to tag up into this gap and we'll see what happens. As you can see here, price tagged into this 15-minute bearish fair value gap, and then we get that divergence between these two highs here on our 15-minute, where NASDAQ creates a lower high and a higher high, and ES creates that higher high and lower high. Again, this is on our 15-minute chart. If I look down on my 5-minute chart now, you'll notice that as we tagged up into this high time frame gap, we also formed a 5-minute bullish fair value gap. So if this gets closed below, that will be my entry. And if you'll notice, that gets closed below right here, turning this into an inversion gap, and we can now take that entry with our stop above this high. And again, we will simply target a 2R. And as you can see, that plays out quite nicely. And that is how I trade my Trinity model. So now you understand the model, not as theory, but as a clear step-by-step process. At this point, most traders assume the hard part is over. But this is where the real challenge starts. Because knowing a strategy isn't what makes traders successful. It's their ability to actually follow it, especially after a few losses or when nothing is setting up. And that's where trading psychology comes in. This is the part of trading most people talk about the most, but understand the least. Most traders think psychology is something you fix before you have a strategy. But in reality, psychology only matters after you have a system that you know works. Let me simplify your trading psychology. It's not about being fearless, it's not about eliminating emotion, and it's not about forcing confidence. Trading psychology is just two things. One is the ability to follow your strategy even after taking a few losses. And two, the discipline to do nothing when your setup isn't there. That's it. If you can do those two things, your psychology is fine. Here's the mistake most traders make. They think they have a psychology problem when what they really have is a belief problem. They don't actually believe that their strategy works. And if you think about it, that makes total sense. You wouldn't invest in a business that loses money every month, but you would invest in a business that's profitable 7 out of 10 months, even if it had losing periods. Most traders don't even know if their strategy makes money over time. So of course they're nervous, of course they hesitate, and of course every loss feels heavy. Confidence in trading doesn't come from motivation, it comes from evidence. If you haven't proven to yourself that your strategy works over a large sample size, your brain has no reason to trust it. And asking yourself to just be confident without proof is unrealistic. Once you know your strategy works, following it stops feeling scary. You're no longer hoping, you're executing. Think about learning how to ride a bike. At first, you're wobbly, you're tense, and you're scared of falling. But once you've done it enough times, you don't think about it anymore. You know you won't fall because you've proven it to yourself. Trading works the same way. Repetition builds confidence, and confidence removes fear. Not the other way around. Here's something no one can escape in trading. Losing streaks happen. How you handle these periods will dictate whether you succeed long term. This is where discipline matters. Not changing your strategy, not forcing your trades, and not trying to make it back. You stick to the process, review the data, and let your edge play out. That's how professional traders survive drawdown. So here's my takeaway. Learn your strategy, prove that it works, then worry about trading psychology, not the other way around. Because confidence isn't something you can think into existence. It's something you earn through evidence and repetition. Once you understand that confidence comes from proof and not motivation, the next question becomes unavoidable. How do you actually build that proof? Because there's only so much confidence you can actually gain from demo trading. At some point, you need real consequences, real emotion, and real risk, without putting yourself in a hole. So next, we need to talk about how to transition into trading with real money the right way. Demo trading is useful, but only up to a point. It helps you learn the platform and practice execution, but it doesn't teach you how to manage yourself. Because when there's no real money on the line, losses don't hurt, wins don't feel real, and discipline is optional. At some point, you need real consequences. Not to gamble, but to grow. This is where prop firms come in. Prop firms let you trade with real rules and real pressure without risking a large personal account. They force structure. You have defined risk limits, max loss rules, and accountability rules. That environment accelerates learning far more than demo trading ever will. You're not trading to get rich, you're trading to prove consistency. Here's where most traders mess this up. They go straight for the biggest account they can afford. That's not the right move. You should start small. I'm talking something like $15 to $25 prop firm challenge. Apex has these. Why? Because the goal isn't the payout. The goal is execution. If you can't follow rules on a small account, size will only magnify your mistakes. Small accounts keep your emotions manageable and your focus where it belongs. Once you're trading with real risk, journaling is non-negotiable. This isn't about writing down feelings, it's about tracking data. Whether you followed your rules, were you hesitated, were you rushed, did your discipline slip? Your journal turns trading from an opinion into evidence. And evidence is what builds that belief that we talked about earlier. That's how confidence actually compounds. Prop firms aren't about shortcuts or flexing payouts. They're about putting structure, risk, and accountability around your process. And once you combine a proven strategy, solid psychology, and real execution, that's when trading finally starts to click. Before you click away, there's one thing I want you to realize, because this is where most people misunderstand trading. None of what we covered works on its own. It only works when it's done in the right order. So let's zoom out and quickly connect everything we learned. We started with mindset, understanding that trading isn't about outcomes, it's about a process. We then talked about having a clear roadmap, so you're not just jumping from strategy to strategy, wasting years. We then broke down how the market actually moves, how a candlestick works, the different time frames, as well as support and resistance, so the chart stops feeling random. I talked about why a mechanical, rule-based strategy matters more than intuition. I then walked through my Trinity model, how to find your bias, high time frame gaps, divergence, and inversion gaps as a repeatable process for you guys to use. After that, I covered trading psychology, why it's simpler than most people make it, and why confidence comes from proof. And finally, I talked about transitioning into real risk the right way, using prop firms, starting small, and journaling so you're learning from data instead of emotion. None of this is about shortcuts. It's about doing things in the right order. If you're brand new, this gives you direction. If you've been trading for a while and feel stuck, this should explain why. And if you've been overwhelmed by information, the goal of this video was to simplify everything down to what actually matters. Now, if you want help applying this instead of piecing it together on your own, that's where my one-on-one mentorship comes in. It's not about signals or hype, it's about helping you execute the Trinity model correctly, staying disciplined, and building confidence through proof and repetition. If that sounds like something you'd want support with, check out the link in the description below. And if not, take what you've learned here, apply it, and stay consistent. That's what actually moves the needle. Either way, everything you need to get started the right way is in this video. Focus on the process, follow the rules, and give the edge time to play out. I'll see you on the next one. Peace.